Stop what you're doing. If you own defense stocks, or honestly, even if you're just looking for the market's next big opportunity, you need to see this breakdown. Here is a totally shocking contradiction for you. You've got a booming defense contractor, breaking revenue records left and right, practically embedding itself into the future of national security, yet somehow its stock just plunged 57%? No way, right? How does a company grow its underlying business that rapidly while its stock falls off an absolute cliff? Could this stock actually be the most mispriced asset in the entire sector right now? Today, we are tearing down the data to see exactly what is happening under the hood of Kratos Defense. We are looking at the divergence narrative. By the end of this explainer, you're going to know for sure if Kratos is a massive, dangerous value trap or the market's absolute biggest mispricing. Let's get right into it. Now let's talk about that 57% drop, because it perfectly highlights a major pain point for retail investors. We all know that stomach-dropping, agonizing feeling, right? You're holding what you think is a great high-multiple stock, and then out of nowhere, bam, sudden share dilution hits, and you are left holding the bag. It is brutal. In an absolute flash, Kratos fell from a peak of over $130 all the way down into the mid-50s. If you were holding that, you are probably panicking. A drop like that makes you question everything about the company. But is the business actually broken? Well, no. Actually, look at the underlying business for a second. While the stock chart looks like a terrifying roller coaster drop, their Q1 2026 revenue just hit a massive $371 million. To put that into perspective, that represents a 22.6% increase over the exact same period last year. And get this, almost 16% of that is purely organic growth. It's not just accounting tricks. So you've got this wild scenario. The actual business operations are growing incredibly fast, but the stock price is shrinking. It is a complete divergence. So let's dive into section 1, the valuation paradox. We need to unpack this extreme divergence and look at the exact numbers that totally spooked Wall Street. You see, the massive sell-off from that $130 peak wasn't because their technology stopped working. It was basically a brutal, necessary reality check. At its absolute top, the stock was trading at a trailing PE ratio of over 900. I mean, it was priced for absolute perfection. The forward price-to-sales ratio hit 12.28x. But the real pin that popped the balloon? Kratos announced a massive $1.35 billion equity offering. That move deeply diluted outstanding shares down to 188 million. And honestly, Wall Street just hit the panic button. Moving right along to Section 2, the Tier 1.5 moat. To really understand why the underlying business is actually thriving despite that brutal stock price correction, we have to look at their unique competitive positioning. I absolutely love this analogy. Think of Kratos as this incredibly agile middleweight fighter stepping into a boxing ring filled with either slow heavyweights or totally unproven rookies. On one side, you've got the legacy primes, your Boeings, your Lockheeds. They're massive, sure, but they are so slow, very expensive, and heavily rely on these multi-decade programs. Then on the other side, you have the new defense tech startups like Endural. They're super agile and software heavy, but a lot of times they just don't have the proven hardware at scale yet. Kratos sits perfectly right in the middle, in this Tier 1.5 sweet spot. They blend that startup-like agile tech with actual battle-tested hardware. And this sweet spot brilliantly illustrates their primary strategy, which is called attributable mass. Basically, the US military is actively shifting away from relying on just a few massive, super expensive, and highly vulnerable platforms. Instead, they want cost-effective, scalable, uncrewed systems. We're talking about drones that can be produced in massive quantities and, frankly, treated as expendable in combat. Kratos is literally leading this charge. They are substituting those bloated legacy systems with affordable, high-volume alternatives, like their famous XQ-58A Valkyrie drone. And here is the exact reason the Department of Defense is paying such close attention right now. By pricing their tactical jet drones at roughly $3 to $5 million each, Kratos vastly undercuts the legacy competitors. I mean, the old guard is charging anywhere from $15 to $80 million for similar capabilities. It's no contest. Kratos completely changes the economic calculus of modern warfare. Let's jump into Section 3, Strategic M&A Expansion. Remember that $1.35 billion stock dilution that made all the retail investors so angry? Well, here is exactly what they did with it. Kratos immediately put that capital to work. They used that newly fortified balance sheet to aggressively expand their vertical integration. In early 2026, they went out and acquired Orbit Technologies for over $350 million in pure cash. That brought in absolutely vital satellite tracking tech.
In just weeks before that, they bought Nomad GCS for nearly $149 million to secure mobile command and control platforms. So what's the big takeaway here? They aren't just building drones anymore. They're buying up the entire communication and control ecosystem that supports them.
Which leads us perfectly into Section 4, a massive contract backlog. Because these strategic tech acquisitions we just talked about, they are already paying off big time.
You can visually see the underlying momentum right here. That massive jump from $302.6 million to $371 million in Q1 revenue was driven heavily by their unmanned systems segment. That segment alone saw an incredible 30.9% organic growth jump. So we're not just talking about potential anymore. The demand is actively translating into real top-line dollars.
And the pipeline fueling all this growth? It is absolutely loaded with major, high-priority program wins across some of the most critical defense domains. We are talking about a massive $446 million Space Force tracking contract, a $175 million Navy radar sustainment project, another $175 million investment in solid rocket motors, and a $68 million facility for hypersonic testing. Kratos is quite literally embedding itself into the very future of national security infrastructure.
All of this relentless execution has culminated in a record consolidated backlog of over $2 billion. Let that sink in for a second. $2 billion. And if that wasn't enough future visibility for you, that backlog is backed by a staggering $14.3 billion bid and proposal pipeline. The future runway for this company is just massive.
All right, Section 5, Financial Reality and Outlook. As investors, we have to connect this defense dominance back to the actual financials. Revenue and backlog are awesome, but we need to look at the balance sheet. Despite the recent stock dilution really angering retail shareholders, we have to acknowledge what that capital raise actually accomplished. That $1.35 billion created an absolute fortress of a balance sheet. During a period where high interest rates are crushing other companies, Kratos boasts zero long-term debt. None. They have a highly secure current ratio of over 4 and nearly $1.5 billion in cash and equivalents sitting there. They are practically financially bulletproof right now.
But there is a catch. The necessary trade-off for this aggressive scale-up is heavy near-term investment. Kratos is currently burning through free cash flow. They're projected to use between $85 and $105 million this year alone. Now, why are they burning so much cash? Because they are building out massive physical infrastructure. For example, they're prepping facilities to be able to produce 40 Valkyrie drones annually by 2027. They're spending the cash today to build the factories of tomorrow.
And this incredibly long-term operational positioning is exactly why the professional analyst community remains incredibly bullish. Consensus estimates right now show 16 strong buy ratings, and their average price targets are sitting over 100% higher than the current mid-50s share price. These analysts are looking past the current cash burn. They see the massive projected earnings growth that is sitting right there on the horizon. So I'm going to leave you with this bold question as we wrap up this explainer. Is Wall Street so hyper-focused on the short-term pain of share dilution that they are completely blind to Kratos' deeply entrenched position in a projected $1.5 trillion defense market? The stock chart definitely shows panic, but the company's ledger shows intense, strategic preparation. What do you think?